Hello everyone, welcome to demand supply uh, trading practical session number 48 for the year 2025. Just give me a second, please. Perfect. So again, hello everyone, welcome to today's YouTube live session, which is on demand supply trading. Myself, Sujit Kakar, and today is Sunday, 14th of December 2025. And before we move ahead with the session, let's get down with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with content related to demand supply trading. So in case you have still not joined the channel and you wish to join it, there are a few different ways you can do it. The first one is you can scan the QR code which is on your screen. Second, if you go to the description of this video, you will be able to find the direct link. You can click on that link and you can be part of this channel. And thirdly, when you visit our website, which is sujitkakar.com, or you can use the short URL that is sk.coach. So just give me a second, I'll quickly show you. So once you are on our website, you can just scroll down on any of the pages. And in the footer section, you'll be able to find this banner which says join Telegram channel, and you can see in front of it you have the join now button. You can click on this button and you can be part of this Telegram channel. And this is where we also keep updating you when these live sessions are happening, so that you can plan your day accordingly if you wish to join the session live. So again, if you're still not part of the channel, you can do so by using any of these methods which I told you. All right, now moving forward, today's session is practical application of demand supply methodology. So now what happens is that once you go through our demand supply course, which is now available as a 100% free course, you learn the complete demand supply methodology theoretically. But unless and until you see some practical examples, at times you don't get a very good understanding of how it has to be implemented. And that is what we do in these practical sessions. So every weekend I do a practical session where we take some real life examples, and to those examples we apply the complete methodology so that you can understand how to plan trades very mechanically and rule based. And plus, the other advantage of this session is that this is a live session. So if you have any questions, queries related to demand supply trading, or even if you have some generic questions related to trading, you can always put it in the chat box, and at the end of the session I try to answer all the questions that we get. Plus, the best part about these sessions is that we are not analyzing something which has already happened, because I always say a move which has already happened, it's very easy to justify it. You can use a number of indicators, oscillators, price action to justify that move. But the real challenge is when you have to do the analysis well in advance, and that is what we do in these sessions. We are analyzing in advance where are the areas of demand and supplies, and eventually when prices they reach those areas of demand and supply, that is when these trades they get triggered. So in a way, we are doing our analysis in advance, and just because we are doing it in advance does not mean that I share these analysis with you and then we forget about it. Whatever analysis I share with you, whenever these trades they get triggered, the very next session we also review them, so that helps you see both the before as well as the after. And once you have seen quite a few examples, by default you start building your confidence in the methodology, and then you're more inclined towards learning it because you can see it working real time. All right. So again, today's session is the practical application of demand supply methodology. And to be comfortable with these sessions, there are some prerequisites which you need to complete. So let's talk about what these prerequisites are. The first one is the Trading Essentials course, optional for someone who already has a very good trading background, though I would highly recommend, irrespective from what trading background you're coming from, always start with the Trading Essentials course. So how do you access the Trading Essentials course? Very simple. Once you're on our website, under services, you can see you have the option for courses. Click on this, and the very first course is the Trading Essentials. The course is available in 2 languages, English and Hindi. So whatever language you're comfortable with, click on that button. You'll get immediate access to the course content. And again, no sign up required, no registration required. Just click on this button, you have immediate access to the course content. Go through the complete the complete playlist of the course. So you have the course designed for you in a very systematic way. You have lesson 1, lesson 2, lesson 3. So just go through all the lessons, and once you have covered all the lessons, that basically covers your Trading Essentials course. Now after Trading Essentials, the second one is your Demand Supply Trading course. Now how do you access Demand Supply Trading course? Same steps. Under services, go to courses, but this time instead of clicking on the Trading Essentials, you'll click on Demand Supply Trading. And this is again available in both the languages, English and Hindi. So whatever language you're comfortable with, select that. Again, no sign up required, no registration required. As soon as you click on the button, you get immediate access to the course content, go through all the lessons, and once you have covered all the lessons, that completes your demand supply methodology theoretically. Now, yes, you will be learning it theoretically when you go through these lessons, but like I said, the challenge is unless and until you see some practical examples, you don't get a very good understanding of how it has to be implemented. And that is what we do in these practical sessions. And plus, we also record these practical sessions so that if you want to revisit these sessions, you want to watch these sessions, you can watch them a number of times, because the more number of examples you'll see, the better you'll start having the understanding of how it has to be implemented. So from here, you can click on practical sessions and you can access the recordings of the past sessions. So currently the archive is almost 2 years of recordings. Again, the practical sessions are also available in two languages, English and Hindi. So whatever language you're comfortable with, you can click on it, get immediate access to the recording of the practical sessions. So this will cover your complete demand supply course, theoretically as well as practically. Plus, like I also said, that almost every weekend I do a live session as well. So this is where you can join in live. And if you have any questions, queries, you can definitely put it in the chat box, which I will be answering at the end of the session. All right, now the next two prerequisites are the rulebook and the flowchart. So what you will see is that during the live session, when I do the analysis, I use two documents. One is the rulebook, the other one is the flowchart. Now, how do you download these documents? Very simple. Once you're on our website, just give me a second, please. All right, so once you are on our website, under services, go to the download section, and this is where you can see you have the rulebook and the flowchart. So just simply click on download. So that's your rulebook and that's your flowchart. Now, how do we use these documents? You will experience it today during the live session. You will see how these documents are used to plan trades in a very mechanical and rule-based way. Now, before we start with the analysis for today, we do have a trade which is getting carried forward from the previous session, and we also have some trades which got triggered during the week. So we will review them, and after reviewing them, we'll start with our analysis for today. So starting with the very first one, this is, just give me a second. This is from session number 40. We did the analysis on the 19th of October. Prices came into the zone on the 24th of November. Last time when we did the review of it, we talked about that yes, we have been into the zone. We got a move which was about 1:1. At 1:1, we can make our trade as a break-even trade. So if you made your trade as a break-even trade, you can see this week we again came into the zone. You would be out of the trade as a break-even trade, but the prices are still respecting the zone. We are still moving up, and we are again above 1:1 as of today. So again, based on our rules, we will close it as a break-even trade because after the opportunity of 1:1, we again came back into the zone. Though the zone is still holding, we are getting a move from it. But yes, like I said, at the end of the day, you need to be a rule-based trader. And based on our rules, this would end up as a break-even trade. All right, now give me a minute. We have a few more examples to look into. The next one which got triggered is from session number 44. So just give me a minute. Let me bring that up. All right, so this is from session number 44. We did the analysis on the 16th of November. Prices came into the zone on the 1st of December. Now, when the prices came back into the zone, the first thing we'll do is we'll check how is the reward to risk ratio. So here you can see when the prices, they started coming back into the zone, the nearest fresh area of supply was this, which was showing us definitely a 2:1. So I'll say that if you're going for a 2:1, this would have been a valid trade. This was also a type 1 trade for us. So what happened, we came into the zone, we got a small bounce. Then again, prices, they started getting deeper into the zone, and eventually the zone got violated, right? So this would be, and this would end up as a stopped out trade for us. So we'll close it as a stopped out trade. So that's your session number 44, which got triggered during the week and ended up as a stopped out trade. All right, give me a second. We have one more to look into. Let me bring that up. So this is from, okay, there it is. All right, so this one is from session number 33. We did the analysis on the 31st of August and the prices came into the zone on the 9th of December. So you can see we did the analysis long time back, which was in August, September, October, November, December, almost after 4 months. Prices came back into the zone. You can see we just touched the zone. We got the opportunity to make it as a break-even trade. And again, after making it as a break-even trade, let's see, did this candle hit the zone for us? The answer is yes. So this would again end up as a break-even trade for us, though it definitely gave us a move as of now, which was close to 2:1. Reward to risk ratio again was not a challenge. We could see that we have a little over 5:1. If you're looking for a fresh area as your target, that is what we are always doing. So based on reward to risk ratio was not a challenge, was a acceptable trade. It was a type 1 trade for us, but only gave us an opportunity to make it as a break-even trade. After that, again, the prices are back into the zone and we are done with the trade. So that basically covers all the examples which were getting carried forward and the ones which got triggered during the week. And now that we are done with the analysis, let's start. We are done with the review. Let's start with our analysis for today. So just give me a minute. Let me bring this up for today's session. Perfect. So first and foremost, whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. In case you've still not watched that video, the link is available in the description. Do watch that video. Very, very important, because this is the most common question I get. That is, how do I remove emotions from my trades? And following that process is the only way to remove emotions from your trades, right? So do watch that video, understand the process, follow the process. The sooner you start with it, the better it is going to be for you. There is no bypassing it. Eventually, everyone will have to go through that process. So do watch that video. Very, very important. Now, since we need to be mechanical and rule-based, what we need to do is we need to create something which is called as a trade plan. Now, when you start learning trading or you're learning a new methodology, it's not very easy to create a trade plan from day one. And that is where these two documents, they come into help, which is your rule book and the flow chart. So in a way, this is a ready-made trade plan for you. Which is definitely a conservative approach, because whenever we are learning something new, it makes sense to start conservatively. But as you start having more and more experience, you can definitely modify this trade plan based on your personality style, based on your preference. So those things can be done, but at least you do have a starting point using which you can start planning your trades. So what is my step number one whenever I'm planning a trade? Step one is I need to define my trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade, and the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit here, the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why am I starting with the trade purpose as my very first step? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We go with a very logical approach, and that logical approach is that the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income means a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days, but when you're trading markets which are not 24-hour markets, so let's say example of NSE India, which is not a 24-hour market, I'm pretty sure all of you would have experienced that whenever this market opens, some symbols they gap up and some symbols they gap down. And because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit which is bigger than what you were expecting in that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market that is not a 24-hour market, we have that gap risk which is added on to that particular setup. So this is why my recommendation to all of you is that initially your hourly dailies will be strictly intraday trades, will not keep them as overnight trades and take that unnecessary overnight gap risk. When it comes to weekly monthlies, we have no choice. We'll have to keep these positions as overnight positions because we are not anticipating to get the exit the same day. These trades can last for a few weeks or maybe even few months. So you'll have no choice. You'll have to keep them as overnight trades. But that does not mean that for weekly monthlies, you cannot have a gap against you. It can still happen. But since you're leaning against some bigger time frames, the probability definitely reduces. But with time, with experience, if you want to include the daily incomes into overnight trades, that can be done. But initially, my recommendation would be do hourlies and dailies strictly as intraday. Don't keep them as overnight trade and take that unnecessary overnight gap risk. So my step one is I need to define my trade purpose. Let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frame I should be using. So if I just give me a minute. Just a second. Right. So from the rule book, I'll get to know what time frames I should be using. So if I go to the rule book, page number 28, we start with the topic, which is multiple time frame analysis. Because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now mind it, this table, which is on page number 31, is specifically for the NSE market because this market is only open for 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like your commodities, forex, cryptocurrencies, international markets, then you can look into this table, which is on page number 32. But since I'll be taking examples from NSE, I'll be following this table. Now in this example, I want to plan monthly income trades. So from this table, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our ACTS from. ACTS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine-tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules. That is also where this time frame can help us. Now, as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but if I take example of NSE itself, so on NSE we have over 2000 companies listed. So humanly not possible that every day I sit and analyze 2000 companies to identify my opportunities. So what you need to do now is you need to have a process in place which can help you get a smaller list of symbols, because if you have a small list of symbols available to you, it is much more easier to do your analysis almost every other day versus going through a very big list. Now that is what our step 2 is. We need to select a small list for us. Now how do we get that list? For this, we use certain computer programs which are called as scanners or screeners. So if you'll do a Google search, you'll be able to find a number of free scanners, free screeners, which are either based on conventional technical analysis or fundamental analysis. But the challenge is that none of these scanners are based on demand supply methodology. Now, the more your process is in sync with demand supply, the higher is the probability that you might be able to find something which is in sync with your trade plan, right? If it is not a process which is based on demand supply, then you might get a list of symbols, but none of those symbols might give you a qualified opportunity. So that is why, to overcome this challenge, I created 2 custom built tools. One is called as the demand supply zone alerts. The other one is called as the screener. Now, if you want to have in-depth understanding of how these tools, they basically work, what you can do is you can come to our website. And once you're on our website, you can click on services, go to trading view indicators, and here you can see you have the alerts in the screener. Just click on subscribe now. It will take you to the product page where the walkthrough videos are available. Go through the walkthrough, and that will help you understand how these tools they basically work. So those are in-depth walkthrough videos, but briefly I'll explain you how these tools they basically work. So starting with the alerts. So this is how you can see you get your alerts. Now, first thing you need to remember is that alerts, they only work during the live market. If the markets are closed, alerts will not work. And as of now, only the crypto market is live. So that is why I have applied the alerts to cryptos to show you example how alerts, they basically work. So you can see here, I've given a list of about 20 symbols, and currently I'm on the 5 minutes chart. So what alerts will do is that out of these 20 symbols, if we have a formation of a demand zone or a supply zone on any of the symbol, during the live market, it will keep updating me. Now, somebody who has a free TradingView account, since you cannot place your alerts on a free account, you will get these updates as a table. Can you see this table will keep getting updated? If I'm on the 5 minutes chart, it will update every 5 minutes. If I'm on the 15 minutes chart, it will update every 15 minutes. If I'm the hourly, it will update every 1 hour. So it will keep telling me during the live market on which symbols out of those 20 we have formation of demand and supply areas. And if you have a paid TradingView account, you can also set your alerts. And what will happen is when these zones they get formed, you'll also get these notifications. Like you can see, I just got this notification. So you will always know during the live market out of those symbols where demand and supply zones are getting formed. So let's take an example. Can you see the first one is BTC USDT? We have a rally based rally. So if I go to BTC USDT and let's change this to crypto, you can see it told us we have a rally-based rally structure. You can see as soon as this rally-based rally was formed, I immediately got to know that out of those 20 symbols, on which symbol I have a formation of a demand or a supply area. So you can see it is still updating, because at times, see the time it updates is when a new candle starts. So what happens is at times there might be some symbols which are a little illiquid. So the next candle might start after a while, but whenever that starts, this gets updated. So this is what alerts is, that during the live market, it will keep updating you where you have formation of demand and supply areas. So that's your alerts. Now talking about screener, how does the screener work? So in the screener, just like alerts, you will give your list of symbols. Here you can see in screener, you can give up to 15 symbols. And then you will select your proximity setting. Like here you can see I have selected my proximity as 2%. So what I'm basically telling the screener is that out of these 15 symbols, on whichever symbol the current candle is within 2% to a demand area or a supply area, shortlist for me, right? That is what I'm telling. And again, for screener, the market doesn't need to be live. Even if the markets are closed, it will still help you identify symbols. So here you can see it is telling me that Bajaj Finance, we will be within 2% to a demand area. And for Kotak Bank, we will be closer to both demand as well as supply. So let's take example of Kotak Bank, because you'll be able to see we will be close to both demand as well as supply. So if you now think about it, if I was doing my analysis manually, I would have to go through all these 15 symbols just to realize that these are the only two ones where I'm closer to demand and supply areas, and that is where my tradable opportunities might be. But using the screener helped me avoid 13 symbols. I don't even have to analyze them. And now you can see I only have to analyze these two. Now let's assume that my list of symbols were, let's say, 150 symbols. So what I can do is, once I'm done with the list of first 15 symbols, I can then input the next 15 symbols. You can even put it as a CSV here. So it makes your process very, very easy. Simply copy paste the set of first 15, then the next 15, then the next 15. Right now, this is for someone who has a free TradingView account. You will have to keep updating it. But yes, somebody who has a paid account, you can apply the indicator multiple number of times. You can apply to multiple charts, and you can have your results in front of you. You don't have to change the list over and over again. So that's how these two tools, they basically work. So again, in a nutshell, alerts, they notify you when you have formation of demand and supply areas during the live market, right? As soon as the demand and supply zones are getting formed. And screener, it helps you shortlist symbols where we are getting closer to a demand area or a supply area. Now, how close, that is completely your choice. You can define based on your preference in the indicator setting, whether you want the proximity to be 2%, 1%, 0.5%, 0.25%, 0% means prices are touching the zone. So that's your call. So again, step 2 is to get a small list. Now, how you get that small list is completely your choice. It can be as simple as I just want to analyze the Nifty 50 symbols, or maybe I have my favorite list of symbols which I want to analyze every day. So choice is yours how you want to get that list. But always remember, irrespective what scanner or screener you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell those symbols. So the scanner screeners, they do not tell you where you need to be a buyer or seller. It only helps you identify symbols which are matching with your criteria. Once those symbols have been identified, you will have to manually analyze them one by one and see which one is in sync with your trade plan. The one that qualifies based on your trade plan might be an opportunity for you, and the ones which do not qualify, definitely you ignore them, and you'll not be trading them. So again, let's assume we got a list, and in that list, the first one was ABC. So what is the next step? The next step is I need to go to the lower time frame on the very first symbol, which is ABC. And that is where I need to identify zone. Now, what do we mean by zone? By zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. Now, I do understand that identifying zones in itself is a very big challenge, and it only becomes easier with time and experience. And this is where we also have another tool which is called as the demand supply zone indicator, which automatically identifies and plots these demand supply zones for us on the chart. And we also provide a 100% free 7-day trial of this indicator. So if you have still not taken the trial, you can do so by visiting our website. So how can you get the trial of the indicator? Very simple. Once you're on our website, under services, go to TradingView indicators, and here you will be able to find the very first one as the demand supply zone indicator. Click on it, and here you will see that on the page you will be having this button that says 7 days free trial. Click on it. It's a very short form which you need to fill. The first thing is your full name, your TradingView username. In case you don't have a TradingView account, you can click here. You can create a free TradingView account. Our indicator works even on a free TradingView account. So once you have created your account, identify your TradingView username, input your TradingView username here. And if you already have a TradingView account, you can click here to visit your profile, identify your correct TradingView username, input here. Now, very, very important, always ensure that when you're inputting your TradingView username, it is correct and it belongs to you, because if you're inputting a TradingView username which is not yours, it will not get activated for you. It will get activated for whoever that TradingView username belongs to. Next, you have to provide your email address, on which date your trial will expire. You will also have to choose the relevant option here. How did you hear about us? And then click on I'm not a robot. I have read the terms and conditions, and then click on finish and start my free trial. The reason it is disabled as of now is because I've still not filled the form, but once you fill it correctly, it will be enabled, and then you will be able to submit this form. Now, once you submit this form, within 24 hours, the indicator will get activated for you. And once it gets activated, you will get the notification on TradingView itself that now you have the access to the indicator, and then you can try it for free for 7 days. So our step 3 was to go to the lower time frame and identify zone. So let's do that. You can see on the lower time frame, I've already applied the indicator. It is identifying all the demand supply areas for us. And from the current market price, you can see we do have this drop based rally structure, which the indicator has identified for us. So let's mark, sorry, it's a rally based rally. Can you see it's a green color candle? It's a rally based rally. So let's mark this zone. So step 3 was to identify a zone. Do we have a zone available? The answer is yes, we do have a zone available. Now, just because you have a zone on the chart does not mean you can trade it blindly. The next step is you need to qualify it, and there is a 2-step process for qualification. In step 1, we'll qualify based on certain conditions, and in step 2, we'll qualify based on the booster scoring. So the first thing we'll check is that the zone we have identified, can this be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area, right? So that is why, in case a shift has to be done, that is what we should be starting with. Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from this is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which is called as a coinciding level. So if you have a coinciding level, there is a possibility it might be a case of level on top of level. But if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone I have identified, does it coincide with any intermediate time frame zone? And here you can see that this is not a coinciding level. Now some of you might say that yes, we have a intermediate time frame zone and my current zone, which is the lower time frame zone, is inside the intermediate. Why are we not calling it as a coinciding level? So this is one of the reason why I picked this example, to give you clarity. See, when we talk about coinciding, what was my definition? I said when you have an intermediate time frame zone and the same intermediate time frame zone, right? So the key word here is the same intermediate time frame zone divides into multiple zone. So I have an intermediate time frame zone, but this zone, right, this is where we have the basing, is not getting divided into multiple zones. This is a separate zone, right? So this area is different, this area is different. So this is basically the test of the zone from where we started moving up, right? So it has to have the same basing to call it as a coinciding level. If this basing is different, this basing is different, these are two different areas. This is not the same area. So that is why it will not be a coinciding level. And since it is not a coinciding level, it cannot be a case of level on top of level. So we have verified the very first condition, level on top of level not applicable. Now this zone is not because of a gap, therefore gap rules will also not apply. Talking about pivot and no authenticity, yes, it was a case, it was a case of rally based rally. So even pivot no authenticity will not be applicable. And in fact, at times, if you are not clear what pattern is this, you can always go to the settings and you can say that show me the pattern name. And now you will see it was showing you the name of the pattern. This is a rally based rally for us. If the font is small, you can also modify the size of the font from here, whether you want it normal, you want it large, you want it huge, right? If I do this, can you see it's a rally based rally? And let's make it as normal, right? So now we know it's a rally based rally. So for rally based rally, we don't have to apply the rules of pivot and no authenticity. So that is not applicable. And unstable equilibrium, I think it was a case of unstable equilibrium. So for a minute, if I just hide everything on the chart, you can see that the leg out is going below the basing, and that is what we call as an unstable equilibrium structure. Now, if you have an unstable equilibrium, again, I think after a very long time, we are looking at a case of unstable equilibrium. Now, how do we qualify it? What we need is that on the refining time frame, we should have a stable structure inside of it. So let's verify that. And in this case, our refining time frame is the hourly. So if I go to the hourly, you can see inside of this, we do have a stable structure, which is a case of rally base rally here. So this is again an example we are taking after a very long period of time where we are applying the rules of unstable equilibrium. So if I go to just a second. So can you see this is what we need to do? If you have the leg out going below the basing in case of demand, we call it as unstable equilibrium. Now, how do we qualify it? That before applying the boosters, we need to check that we have a stable zone on the refining time frame. So can you see we had something like this, the leg out was going below the basing, but on the refining time frame, we have a stable structure, which is a rally based rally here. So that is why if I talk about the rules of unstable equilibrium, based on this, it is definitely qualified for us. So it was an unstable equilibrium, but when we applied the rules, it got qualified. So after applying all the applicable rules, is the zone qualified for us? The answer is yes. So now that we know we have a qualified zone, does not mean we'll trade it blindly. The next step is we'll have to now qualify based on the booster scoring. So let's start applying the boosters. We'll look at the quality and the probability factor now. Let me draw this. All right, starting with the first one, which is freshness. The zone is definitely fresh, gets a score of 3. Strength, we have, it's not an explosive move. It is a good move. We'll give it a score of 1 because if you look at my settings, since I'm on the daily time frame, I don't mind using even for a regular setup with a good strength. If I make it as explosive, it might not get qualified. Can you see now the indicator is not identifying it, but we do understand it is a zone with a good strength, right? So that is why I can give it a score of 1. Time at the zone, we only have one candle, which is a score of 2. Reward to risk ratio will take as an assumption. So it is a high quality zone, definitely with the assumption of reward to risk ratio. Talking about location, you can see that we are planning our trade very low on the curve, which is the best location. So we are planning at the best location, gets a score of 2. Now at best location, trend becomes irrelevant. Doesn't matter whether it is up, down or sideways. All 3 trends will get a score of 1. Move from the zone, we need at least a 4:1. We have a pretty big move, therefore we can give it a score of 2 for that as well. Talking about a level on top of level, we have already verified it's not a case of level on top of level, not even coinciding. And talking about trap, in a way it is irrelevant. Why did we get 32 here? Did I make some mistake? Okay, I think this is the formula has been removed, right? So that is why it was showing us 32. Otherwise, it should have worked perfectly fine. Let me just close this and maybe open it again. Otherwise, I'll have to do the booster scoring manually this time. Just a second. Yep. So the formula has been removed. So anyways, this was 3, this was 1, this was 2, and this is again 3, right? And this is 2. Trend is irrelevant. Move has already happened. It is not a case of level on top of level. This is also 0. So the fact is, like I was saying, we already have a high quality, high probability setup. Therefore, we don't even have to look into trap, because even if it is 0, we still have a type 1 trade. But let's verify that can it work like a trap. For this, I'll take a horizontal line wherever my zone is and start pushing it up, trying to find an area where the prices have been bouncing over and over again. So if I just look at this area, can you see it has been working like support. It has been working like support, working like resistance, resistance, working like resistance, working like resistance, working like support, working like support, working like support. So we have almost a textbook example of support and resistance, and our zone is sitting right below it. So what will happen is people who believe in support resistance, this is where they would like to buy as support, and their stop losses will be below this, and those stop losses will be sell orders. And plus, if we get a breakout, people who believe in breakout will also start selling. So we understand by the time we are entering into this area of demand, we'll have a lot of selling coming into the market because of the breakout traders, because of the stop losses. And now these people are making 2 novice mistakes. Selling after a decline in price means selling at a cheaper price in an area where the chart has proven to us that back in history, demand exceeded supply, which could be the only logical reason for the prices to move up. So yes, that possibility is there that this can work like a trap, for which I can again give it a score of 1. So if you look at the overall scoring, we have a high quality, high probability zone, and high quality, high probability can be traded as a type 1 trade. So after applying the boosters, we got to know this is a type 1 trade for us. Now, no matter how high the quality or the probability, any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do a proper position size calculation. Now, whenever the prices are back, we'll have to re-verify, because the markets are not static, markets are dynamic, conditions are changing almost every other second. So before entering a trade, we always need to re-qualify it and check, does it still get qualified based on my trade plan? If the answer is yes, you place your order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step is your trade management, where step 1 is 1:1, we make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we start trailing it unless and until we get an exit. So this is how we plan trades, very mechanically, very rule based. And if these sessions are helping you plan better trades, then do like the video. If you have any comments, if you have any feedback, you can always put it in the comment section. And most important, I'm pretty sure you people also understand that a lot of people are struggling with trading. So if you have any friends, family members who are into trading, or if you're part of some trading group or trading community, you can share the link to my courses. They are 100% free. Link to these live sessions, they are 100% free. So all this free content is available. So the more you share with your fellow traders, the more number of people can take advantage of it. So do spread the word. Plus, like I said, we also have that trial of the indicator, you can also share it with your friends, with your trading community, so that more and more people can take advantage of it. And before we start with the Q&As, I would also like to add one question or feedback which I was getting from you people, that what if I don't want to ask my question publicly during the YouTube live session, or what if I want to share my analysis, which is not possible during the YouTube live session. So how do I do that? For that, we have an option which is called as one-to-one session. So once you visit my website, on the top right corner, you'll see one-to-one. And there are two kind of appointments available. One is a voice call. So if you feel on a telephonic conversation, you can get your answers, you can go for a voice call. If you feel you want to share your screen, you want to share your analysis, you can then even go for an online meeting. So these two options are definitely available from the one-to-one appointment. But yes, if you're okay with asking your questions, queries during the YouTube live session, you can always put it in the chat box. And at the end of the session, I'll take your questions, queries. So let's see what questions we have today. I'm Peter, watching live from Uganda. All right, perfect. What is a good time frame to trade in Indian commodities market like crude oil, NG, gold, silver, etc.? So see, again, I would not say what is a good time frame. I would say whether a setup matches with my trade plan or not, right? A setup can be on a 1 minute chart. If it qualifies based on my trade plan, yes, it is a good time frame because it matches with my trade plan. If I'm planning my trade on a 60-minute chart, but the trade does not qualify on my time frame, even though it is a bigger time frame, I'll say it's not a good time frame. Why? Because the setup is not matching with my trade plan. So again, the condition is always that the setup has to match with your trade plan. If it is qualified based on your trade plan, it can be a 1 minute chart, it can be a 60-minute chart, anything. But obviously, depending upon whether you want to do intraday trading, whether you want to do swing trading, you want to do investing kind of trading, you will choose time frames based on your preferences. But at the end of the day, time frame, yes, it has a little bit of weightage. Like I always say, the bigger the time frame, the higher the weightage. On smaller time frames, you need to be more selective when you're planning your trades. But yes, at the end of the day, the trade setup has to qualify based on your trade plan. The time frame in itself will not have a very big weightage. Okay. So adding multiple indicators, will there be any lagging signals? How do I backtest this? See, again, if you will be adding any of the indicators, conventional technical indicators, most of them will always be lagging in demand and supply. You can always see, even when we did the review today, you can see we already had our zones marked. Prices came into the zone. From there, they are bouncing. Now, once they bounce from that zone and then they start moving up, then probably some of these lagging indicators will start showing you indications which you might be looking for. So with demand and supply, trust me, majority of the indicators will not be able to help you because they're always lagging. So again, that is why we don't use any of the indicators along with demand and supply, because they are mostly lagging and we will not give you any advantage at the end of the day. All right. How many times target on lower time frame is better than the target intermediate time frame or HTF in case of best locations? What should we do? So many times target on lower time frame is better than the target on the intermediate. Better than the target on intermediate time frame or higher time frame in case of best locations. What should we do? See, again, when you are planning your trade at the best location, the first thing is you definitely understand that you can get a nice big move in your favor because you're already very low on the curve, and if prices they start moving in your favor, it has a lot of room before it hits the very high of the curve. So yes, if it shows you better target on the lower time frame, definitely you can look into it, even if the intermediate is showing you a little less. But always remember, just because you're seeing a better target does not mean you don't lock in whatever is on the table, right? You'll have to use your trailing stop loss so that in case it starts again going against you from that intermediate time frame zone, at least you have locked in some profits and you get those profits in your pocket. So as long as you are taking care of it, that you're not leaving anything on the table, you are locking it as much as possible, you can definitely trail onto it from using your your lower time frame, because that was showing you the best target compared to the other time frames. All right, let's see what do we have next. So on the weekly, why the above zone is not marked by the indicator? Let's see which zone you're talking about on the weekly. So this is the nearest zone, right? So when we talk about where are the nearest demand and supply areas from the current market price. This is the nearest one. Then we have this one, which the indicator is marking perfectly. So I don't think the indicator is missing any of the areas here. All right. Can we not consider the zone as a drop base rally? So do you mean this as a drop base rally on the daily time frame? See, I also felt that this is a drop base rally initially, but when I zoomed in, I can see that the indicator is taking this as a leg in, and that is also what makes sense, because if I just remove the indicator for a minute, now you can clearly see that this candle is pretty small compared to, you know, these candles which you have on both the sides. So this is what the basing is. This is your leg in, right? So, and that is the advantage of using the indicator. Your process becomes much more mechanical. And now I guess when I disable this now, it will be much more easier for you to understand that this candle is pretty small and should be taken as the basing. This candle is not as small to call it as a basing candle and then call it as a drop base rally. So the indicator is working perfectly, identifying it correctly. All right, so one more question. As you have discussed in January, outcomes of all trades, this on the basis of strategies better to 2:1 or target based on the rule book? See, again, this will depend upon a lot of factors, right? The very first factor can be how aggressively or conservatively you're planning your trade, right? The second factor can be what kind of trades do you take? Are you more into intraday trading, HIT trades? Are you more into MIT trades, right? Plus, it will also depend upon what your outcome has been when you're looking at, let's say, your set of last 50 trades or 100 trades. So you will have to gauge from your experience what is working better for you. If you feel that if I'm always exiting at 2:1, and if I do my review based on that, and that gives me a better result versus I was just waiting for the targets and prices, they went against me, maybe break even trades or maybe small little profits, and that did not give me as good profits if I would have exited at 2:1. That is how you start modifying your rules for your trades, right? So that is the only way to create a better trade plan. Based on whatever you have experienced, modify your trade plan so that you can get the best output out of it, right? That is how you have to go about it. So you will have to see what is working best for you, and since that can only be done when you're logging your trades, always log your trades, always look back and see what performed better for you, and whatever is working for you, that becomes. So again, just as an example, you start with your version of 1.0 of your trade plan. Once you review it, you find, okay, this is working better, you make it as version 1.2, right? Or maybe 1.1. Then again, if you get some data out of it, you feel, okay, some modification is required, you make it version 1.2. And that is how you keep updating your trade plan as well based on the results you're getting from your trades, right? That is how it has to go about. How do I test which time frame suits to the script? See, again, it is not about which time frame suits to the script. If you are trading a script which is liquid enough, any time frame can be traded provided the setup is in sync with your trade plan, right? That is how it has to be. So the best way is to define your time frame is, like I always say, whether I want to do an intraday trade, whether I want to do a swing trade, whether I want to do investing. So how long I want to be in the trade. Based on that, I should be selecting my time frame, and once I've selected my time frame, then we start planning trade on that particular time frame. That is how it has to be done. So can we get details of indicator like blue, black color coding? So if you go through the walkthrough video, everything has been explained. So just go through that walkthrough video, which is available on the product page. All the settings, all the features have been discussed in that walkthrough video. Talking about the third supply zone, which is not marked on weekly. See, again, Pavan, what you can do is probably you can take a screenshot and you can send it to info@surjitkakkar.com. I mean, my team will definitely look into it and revert back, because I'm not sure which third one you're talking about, right? You can just take a screenshot, mark it that this is the zone I'm talking about, why the indicator is not marking it, and definitely my team will revert back to you with a reply on that. Perfect. So thank you everyone for joining in. I will be seeing you now next weekend. Until then, trade safe, enjoy your Sunday. Take care. Bye-bye.